Good morning, everybody. My name is Yohmed Gutierrez. I'm your strategic banking ally here at GeeGoals, where we help small businesses get connected, banked, and funded, and with capital structure, specifically in debt financing. Today, I want to talk to you about 5 risk factors that might hurt the small businesses when trying to obtain a business loan. As you know, trying to get a small business loan can be complicated sometimes. If we're trying to get a loan with a bank, they ask for a lot of paperwork. If you're trying to get a loan with a fintech company, they might not ask you for a lot of paperwork, but they might charge you between 20 and 30% on a loan. So the real option here is to find the balance and also find what actually works for you based on your industry. Doing a good capital structure might definitely help you get the best of the best when it comes to capital. Also, you have to make sure that those funds would help you get to that next milestone. That might be revenue, might be a government contract, might be a corporate contract, or it might just be continuing the operations on your business. So let's talk about those 5 risk factors that might hold you back for getting an affordable and responsible loan. Number 1, no principal reduction and credit lines. Line of credits, business line of credits, however you want to call it, is a name that is thrown around in the internet like anything. Credit cards are called line of credit. Fintech line of credits that literally have rates up to 80% are also called line of credit. Banks also have line of credit. Today I want to focus on those who are from the bank specifically because they have better terms, better rates, and usually come with better service too. Responsible lenders expect you to recycle that line of credit, not just carry a balance forever. If your credit line doesn't show principal reductions over the course of a year, it may signal weak repayment ability. So how do you fix this? You need to review how exactly is that you're using that line of credit. Are you using it to buy inventory? Are you using it to pay bills? Are you using it as a way of financing your customers? You gotta ask those questions and then analyze your sales cycle. What is going on? Are your clients paying more slowly? Have sales dipped? Can you improve collections using a third-party lender? That way your line of credit is only for you and you're not using it as a way to finance your clients. Remember, any responsible financial provider wants you to use that line of credit wisely. Especially with banks, the line of credit might have terms between 3 to 5 years, but it's meant to be used within a year. And when it comes to using the right line of credit, think about it, folks. You might want to get a line of credit like yesterday. Literally, you can go to companies like Headway Capital, and you might be paying literally at least 25% at a minimum on that line of credit that is only amortized for 18 months. Your payments are higher than one with a bank. And if you use a credit card as a line of credit, like the ones from American Express, for example, they might give you a 0% promotional rate for the first 18 months or even 21 months. But after that, that rate goes over 30% or 25%. Usually with a bank line of credit, you're looking between 10%, 12%, no more than 15%. You do the math and decide which one will be better for you. Number 2, consistently missed or late payments. Put yourself on the shoes of a bank right now. Imagine if a family member, somebody that you care about, asks you for money. And you decided to say, hey, I'm gonna give you $1,000, I'm gonna charge you 5% over the course of a year, and I need you to pay me back in 2 years. And every month, that family member is either late or it's just not paying you overall. After those 2 years, he actually paid it off. The next time that he asks you for money, be honest, would you give that person that $1,000 again? You probably would find somebody else to say, or you just probably say, you know what, I don't have it right now. Maybe next time I help you out. It's exactly the same with banks. Of course, more complicated, with more financial implications when you don't pay, but the concept is technically the same. How do you fix this? If you think that you're gonna be late or you're gonna miss a payment, Be proactive. This is where the first C of capital, character, comes in play. Call that banker or that lender and say, hey, I'm having this situation right now. Can you put the payment instead of for the 5th of the month to the 20th so I can help you, so I can actually pay you. That way it doesn't affect my relationship with you. Sometimes, especially on communities of regional banks, they might not report that late payment to the credit bureaus because they want to keep you as a client, right? And they want to have that relationship with you. But that doesn't mean that they're not taking note. What usually happens is that next time that you ask them for money, they actually give you a high interest rate or they give you less than you can actually qualify for. Again, your history actually matters when it comes to access to capital. So how do you fix this? Once again, communicate early. Tag, be upfront. Transparency builds trust, especially with local and regional banks, or even CDFIs. Over time, better payment habit will restore confidence in your ability to manage debt. Number 3, budget showing reduced cash flow. Lenders want to see that your business generates enough cash flow to cover the debt comfortably. If your budget or profit and loss shows declining cash flow, your debt service coverage ratio weakens, and as a result, your borrowing power. So how do you fix this? Build or revise a budget that actually reflects your reality. Show how you will strengthen cash flow through expense adjustments, revenue growth, or improved collections. A clear plan to rebuild your debt service coverage demonstrates financial responsibility and reassures lenders that your business can manage repayment. Number 4, shrinking cash reserve. To a bank, it raises a lot of questions. For example, what happens if there is an opportunity? What happens if there is an emergency and you need that cash? Without cash reserves, your ability to repay debt looks uncertain, like the economy. So start building your cash reserve for at least 3 to 6 months of operating expenses. Even small and steady contributions add up. Remember, even big corporations like Apple, they keep significant cash reserve while still leveraging financing or equity for growth. In this case, small businesses may not have access to equity, but you still can get a good bank line of credit. Cash reserve prove resilience and give banks confidence in your long-term stability. Also, your cash reserve doesn't have to just sit around on a savings account just collecting dust and devaluing due to inflation. Talk to your banker, see if they can put that money on a CD for like 3 months or 6 months. That way it's at least earning some sort of interest. Or if you have a financial advisor, talk to them and see if they can do a micro portfolio just for you, for those cash reserves that you have on your business. Number 5, utilization of cash advances. Boy, oh boy, this is big. Merchant cash advances, revenue-based financing, they all sound the same, but believe me, it's not, and I will do a video about talking about the difference between them. This type of financing, which I'm very familiar with, can often hurt your long-term profile more than anything that I mentioned so far. So a responsible financial provider, by you relying on cash advance loans, you're technically telling them, number 1, that you needed capital so urgently that you couldn't wait, either for an opportunity or for an emergency. Number 2, that your personal or business profile don't look good at all. Or number 3, you might be hiding profits in order not to pay the IRS taxes. Yes, bankers know that. Everybody knows that. But again, the bank doesn't work for the IRS. So when you have 10 years in business, making $10 million in annual revenue consistently, and showing only $50,000 in net profits, and you go to the bank and asking for $3 million, don't be surprised when the bank says, not really, buddy. Maybe you go and talk to that cash advance lender. I'm pretty sure they can give you those $3 million. With daily and weekly payments and a rate of 20% as a minimum and 30 to 40% as average. Does that sound to you like a good financial move? Well, you'll be surprised. I don't know. Many of you might say no, but I know for a fact that some industries can take cash advance loans all day long and still show profit at the end of the year, depending on your industry. But that is not the case for every single business out there. So you be very careful with those cash advance loans. But let's say that you already have it. I would say pay it off as quickly as possible. And after it's paid off, I need you to sit down and identify the reasons that you needed it in the first place. Then list the pros and cons of using this type of financial for your business. And then decide by yourself if you would use it again. If the answer is yes, well, good luck to you, my friend. If the answer is no, work with your banker on a strategic banking ally like the ones that we have here at GeeGoals. Stay in the sustainable financing path by being proactive and not reactive. By identifying these 5 issues and taking the steps to correct them, you position your business for stronger financing terms, higher loan approvals, and more competitive rates. At GeeGoals, we help businesses connect with local and regional bankers and CDFIs for financial products and services. Literally only 12 questions and you can get connected directly with a financial provider. No broker fees, no credit checks. As long as you are honest, you are 50% closer to get the capital that you need. Don't wait for a decline to know what went wrong. Go to GeeGoals.com and sign up today. And to build sustainable businesses through debt financing, you follow GeeGoals. Have a good day.